Closing entries are a necessity when it's time to close the books to say goodbye to one fiscal year and say hello to another. We close temporary accounts, and this might seem repetitive, but since so many of you are gone, I think it's worth talking about again. Close means to zero out. So in other words, we're saying, okay, what happened 2017? Let's close those books, funnel all of the money in and money out to owner's capital so we can start fresh in 2018. We close all revenue. We close all expenses. And we close all drawing. When we zero them out, we have to put them somewhere. And the income summary is a one-day account used to close. That eventually gets closed. And it all funnels into capital. So the owner gets to keep the good stuff, the owner takes a hit on the bad stuff, meaning the owner gets to keep all the revenue, the owner gets the hit on expenses and drawing. Okay? Permanent accounts that are not closed, they get rolled into the next fiscal period. They roll over. All assets. We wouldn't throw the pile of money away. We wouldn't throw our unused pencils away. We wouldn't get rid of the school bus. Okay? All liabilities, these folks are not going to say, oh, it's 2018, you don't know us anymore. That doesn't happen. Okay, and then as far as owner's equity, just the capital account rolls over. So maybe even if you were lost yesterday or gone yesterday, you're like, well, that makes sense. That's easy. Okay, as far as closing entries go, there are 4. It's going to feel like this problem's going to take forever because we're going to say what the closing entry is. We're going to do the T account, and then we'll go journalize. Okay? So why don't you find exercise 4.7 in your workbooks? Find it in your workbooks, find it in your textbook. So it's going to feel super slow because I'm going to, again, tell you what the closing entry is, do the T account, roll it over to the journal entry. Cool? On the test, you would only do this. On the test, I will provide this little Mrs. Mars version, like what we're doing, but if this wouldn't be graded. Cool? All right. One thing I want you to do, we're going to talk about income summary. And I don't know if you want to put this somewhere in your notes. I don't know where this goes. But let's talk a little bit more in depth about income summary. Remember, income summary is a one-day account. It's a holding tank. Again, you're not going to hear the book call it a holding tank. It's just the Mars version of it. And it's used to close revenue and expenses. Its kissing cousin, actually its identical twin really, is the income statement columns of the worksheet. I just sensed a little bit of confusion yesterday about this, and I wanted to just recap. All right, let's just mark up a little bit. A credit would be to close sales. A debit would be to close expenses. I'd say rarely do those equal. Would you agree that they're not going to equal? Which do you usually have more of? Revenue, okay? So when revenue is greater than expenses, you have a net income, which will involve a debit to income summary. That's going to be 9 times out of 10 that's going to happen. The next problem that we do together is actually going to be a net loss. I want you to see how this looks from a net loss perspective, and I'll walk you through it. So if revenue is less than expenses, in that rare case, we would have a net loss, and it would be a credit to income summary. So then what I'd like you to do here, put two boxes. This one is if it's a net income. This one is if it's a net loss. Its partner account would be capital. So if we had a net income, you'd credit capital. If you had a net loss, you'd debit capital. I just thought talking about that a little bit will help clear up any confusion. Should we do this? Should we do this? Should we do this? How many trial balances do we have in the course of a full accounting cycle? 3, says the girl who wasn't here. Thank you for watching the video. Love it. Thank you, Jenna. We have a trial balance, we have an adjusted trial balance, and we have a post-closing trial balance. Okay? So at the bottom of page 195, it says K. Magel Company had the following adjusted trial balance. So our debits equal our credits. We've done all the adjusting entries. So they're saying we're really close to closing the books, but we actually have to close the books. Prepare closing entries and prepare a post-closing trial balance. So what I want to do first, before we actually do all of our entries, I want to come in and put in all of our totals. Okay. Here's where I'd use pens, pencils, highlighters, just to see where the numbers go. I'll use black first. What's our sales balance? Or revenue, excuse me. What's our sales or revenue? 4,300. So I want you to put that balance in. They're saying coming into the closing entries, we've got $4,300 worth of sales. Plug that in. How many expenses do we have? I only think, I only see 3. Do you guys see 3? Okay. So let's put their names in first. The salaries and wages expense, the miscellaneous expense, and the supplies expense. Those all had balances coming in. 1,344, 256, and supplies expense had 1,900. Why are we debiting those? Why do those have debit balances? Are they naughty and offset what the owner is worth? Okay. What else is naughty? Drawing. I don't know the owner's name for sure. What's the owner's capital account at? 5760, was that correct? So coming in, this is what, now these are all just the temporary accounts for the most part. Remember, this is do not close, this is permanent. Do we have some things that have balances that will carry over? Absolutely, all the assets, liabilities, and that capital, okay? Well, why don't we even see income summary in the list? We don't even see it there. Because how many days of the year do we need it? 1, and it doesn't really have a balance. It doesn't have a normal balance side. It's just kind of an it account that we use to close sales, close revenue, and hope for close expenses and hope for a net income. Okay, so coming in, there's our balances. We have not closed anything. We just updated everything. So let's do our first closing entry. Our first closing entry is to close or zero out revenue or sales. The two are interchangeably used. Into where? Where do we dump it for just one day? Income summary. All right. I'm going to switch pen colors. If you're using a pen, maybe switch to a pencil. We need sales to equal 0. We need sales to equal 0. Are we going to debit or are we going to credit for $4,300? Debit. Why would we not credit? It would add it. It would double it. So you guys are saying debit, because had we credited, it would have doubled, and that's not. And I would definitely put that little subtraction out there just for you to see it. Okay. Okay. I see a debit. Let's not even talk about where it goes, but what's its partner need to be. I see a debit. We got to put a credit somewhere. Where are we dumping it? According to what we just did down here in our cheat sheet. Income summary. Are we even going to put a plus or minus there? No, it's kind of an it account. It doesn't really have a debit or credit. What I would do is just put sales next to that so you can remember, okay, let's hope sales or revenue are bigger. What just happened is we have our first entry actually ready to go. And what I do is highlight that debit and credit, just so we can see that there's our first actual entry. Could you have done all of this and done the entry without this commotion? Yeah, you could have. But remember, the teacher in me wants you to know where the numbers are coming from. So now, let's journalize that, what we just did. So what you just highlighted, the debit and the credit. We debited service revenue to zero it out, and we dumped it in income summary for just a minute. We zeroed that out, and we dumped into the income summary just for the meantime. This is the format you'll see on the test. If you don't want to do this one on the test, you don't have to. But some people who are very visual will like this there. Okay? How many more do we have to do? We've done one. We have 3 left. All right. The next thing that we're going to do, close or zero out all expenses into income summary. So these expenses, we want to equal 0. We want to equal 0. Third one, we want to equal 0. What would be wrong with debiting all of those? It would double it. We want to zero them out, so we actually want to credit each of them. Is boredom starting to set in for some of you? Because you're like, we get it, Mars. This is an awesome lesson where I yearn for you to be bored because you get it. I see 1, 2, 3 credits. The debit credit rule tells me that what do I need partnered with those credits? A debit. Could we lump them all together as a debit? We sure can. Okay. Here's me just not wanting to do math. Let's see what it is. Is it 3,500? I bet it is. It is. I should just listen to you, Carrie. Okay, so I will take the 1, 2, 3 credits to equal 1 debit, and I'm going to put expenses there. Could I list them separately? Yes, I could. Now I'm going to grab my highlighter. I'll maybe switch it up. It's up to you. But I've got 1 debit, 3 credits that I'm simply going to go journalize. The act of crediting these is zeroing out and dumping. Just by looking at this, Do we have a net income or loss? Income. Tell me why, Carly Fair, we have an income. Yep, 4,300 is definitely larger than 3,500. Just remember, in a hurried situation, I'm okay with, you know, NISC expense, SW expense, but in a, say, BPA contest scenario, they'd probably want you to spell them out. We're on to what I think is the hardest closing entry. It's this whole business, okay? We need to close income summary. I'm kind of running out of room here, so I'm going to just clean that up. Close income summary into capital. This is the exact duplicate of what happened on the worksheet. We basically want to get these two to match. So we pull down the bigger number. 4,300, we need it to equal 4,300. Again, that's exactly what's happening on the worksheet. When it's a net income, are we going to debit or credit? We're not going to put the difference on 4,300 because that would make it go up. We would debit. I want you to put net income out there. The reason we had a net income is because of this. Our expenses were less than our revenue. Okay, so what is 4,300 minus 3,500? 800? Who gets that money? Is it 800? The owner. Okay, we have a debit. So the owner has to get a credit, and that's applause. Woohoo, it's starting to work. You guys running out of highlighters? I've got many up here. So that 800 is money in the pocket of the owner. A debit has to be a credit. The cool part is I see a plus. It all works out. What's happening here is we are closing. I don't want to use the word close. I want to zero out. And we're going to dump into. Nice part here, this is a permanent account. And the owner is getting, and in a lot of times students will put net income right there so they can see that that's net income instead of a net loss. Call it income summary. Basically on this third one, it's a 2-for-1. It's taking a look at revenue, it's taking a look at expenses, and hopefully revenue exceeds expenses and it's money in the pocket. How would this look if it was a net loss? It'd be flipped. Okay, and that's what the next problem is. Last one! What else do we have to close? What's another word for close? Zero out. What are we closing out in the last one? Close drawing into capital. Because you know what? This owner is sitting there with 5,760 plus the net income, but he or she took money out of the business. Okay. So we need this to equal 0. We are going to debit or excuse me, credit. Because if we would debit, we'd double. We want to force it to be 0. I see a credit. So what does the other side have to be? Okay, and luckily for us, I see a minus sign there. This is how accounting is like fabulously right or wrong. It's black and white. It's right or wrong. And that's what makes it quote unquote easy. Now I wouldn't say this is easy. Plus it looks like we've been in an elementary classroom doing an art project. So full of color, but I hope the colors make sense to you. What color haven't I used yet? Yellow? Okay, green. Okay, so then I'm going to just highlight here, and do that entry. So we are zeroing out drawing, dumping into capital, and that's a hit against the capital. We're actually not done. We've done our entries. That's what it will look like on the test. Could you do it? Maybe even without this, possibly. Our last step here is that we need to do what's called a post-closing trial balance. I don't know where it went. Yeah, here it is. Is it in your book or is it in your workbook somewhere? Okay. Does it say post-closing trial balance on it? Okay. And that's just the last-ditch effort to make sure our debits equal our credits. Okay. The only thing you'll see on here, and I want you to write this somewhere, only permanent accounts. So the assets, the liabilities, and the capital, because everything else has a 0 balance at this point because we've zeroed them out. Hence the name post-closing. We're doing this after we've closed. Where are you getting all of this? You're pulling it from what's on page 196. The reason you do not see any money in or revenue, any expenses or drawing is because that basically all has funneled here. And I'd put like all temporary accounts have landed here. We're going to have our debits on the debit side, we're going to have the credits on the credit side, and then we single and double rule to make sure that they still equal. Pretty easy? I hope so. All right, so this is 4-8. The tricky part is that there's 2 revenues, and so let's plug them in. So instead of sales, put service revenue. And let's go ahead and put its balance in of $64,000. Let's make ourselves another T over here. Rent revenue of $6,500. Okay. While we're here, let's plug in all the expenses. Do you have 3 expenses? Yep. Depreciation expense, and that's rocking a $8,000 debit balance. Depreciation expense, holy moly, $55,700. And then utility expense, of 14,009. Okay, so are we missing one? Oh, so this one is salaries and wages. Let's double check. Okay, depreciation's 8. Salaries and wages is 55,700. We must pay our employees well. And then utilities expense of 14,900. Okay, so you're going to have your number here to close sales. You're going to have your number over here to close expenses. And what I'm telling you is your expenses are going to be greater than your revenue. So then you'll have to plug in a number as the credit. Okay. I think, and I can double check on the answer key, but I think, you know, just how like when we have many expenses, we just dump them in as one debit. I'm assuming since we have several revenues, we dump those in as one credit. But I want to just peek to double check. I think it's way ahead. No, I got to find my answer key here. Where are you? Yeah. So do you see? So when we have many expenses, we dump as one debit. When we have many revenues, we dump as one credit. Do you see how that works? Okay. And I can tell here, here's where I can tell, 78,600 is definitely greater than the 70,500, resulting in what? When we have larger expenses than revenue, it's a net. Okay, I think you can do this, but I'd like, you know, I bet you could do this whole thing. But what I'd like you to do is just get this far, close revenue, close expenses, and why don't we, I don't know where it keeps hiding. Oh, there we go. Why don't we close income summary together? Okay, so get that far. All right, so just remember when you're closing, you're zeroing out. You're forcing the balance to be zero, whether it's the revenue, whether it's the expenses. If you would put it on its normal balance side, it would actually double, not zero out. You have to do opposite to push it to be zero, and that's why I try to put the minus signs there, okay? Well, if I have 2 debits, I need 1 credit to close that out. If I have 3 credits, I need 1 debit to close those out. And that's where you can see that we have more expenses than we have revenue. So we lost money. It's called net loss. And so then the difference is over on this side. And remember, if you go back to that little cheat sheet that I just went through with you, that it should force it that way. What is our net loss? Say it again. Okay. Ouch. It's kind of a big net loss. Okay. So I have a credit. What's the other half have to be? Let's not even hunt for it yet. What's the other half have to be? A debit. Where? Capital. Does that make sense that the owner has a hit? He takes a financial hit. What was his balance going in? I hope it was bigger than 8,100. 45,200. Okay, he's doing okay. But what hit is he going to experience here in just a minute? Drawing. I just wanted to do this part with you because remember, we're bringing down the larger number, 78,000. Let me start again there. 78,600 needs to equal 78,600, just like it does in the worksheet. What I'd like you to do is try the drawing one next. I'm partially doing this one. You guys are. Where in the world? There we go. I can't find it. Oh, here it is. There you are. When you close revenue, when you close expenses, it always will look like this. This third one is a game changer if it's a net loss. I would like you to try to do the post-closing trial balance on your own. I know there's one of these in there. I don't want you, we're not going to actually do this. So the little ledgers, that's probably next, you don't have to do those. What I would like you to do, though, is your post-closing trial balance. I'll leave this up for just a minute more, though. Yes. Was that his balance going in? That was just a balance of going in, and then you saw 2 debits that offset that because it was a net loss and drawing. So no, it just kind of shows you his final balance, which you will need for the trial closing trial balance. Speaking of, I want you to try to do your post-closing trial balance by yourself. I will leave this here. Notice we've got accumulated depreciation as a contra. It's got a credit balance. That's a recap from last time. And what Riley just asked, you know, what does the capital balance matter? Because you need it to figure out his final capital balance. So that's where I'm going to stop the recording. I'll leave it on your screens, though. Try not to be reliant on looking at it. Just shoot from your gut instinct and use it as just a checkpoint.